I wonder if I may put a canard to bed. It is true that I made a seven-figure sum notionally on shorting Northern Rock shares. And to be precise, the figure was £1.3 million. But that is not the basis of my complaint, far from it. It is that, in fact, £400,000 of that was never paid to me at all, since the Scottish stockbroker direct share deal through whom I did the trade obliged me by being run fraudulently, and they stole the money, and that still irritates me, frankly, since it's not so much the money. Well, I wouldn't mind someone sending me a cheque tomorrow for 400,000, but anyway, the fact is that what irritated me at the time was that the then FSA, now FCA, the two bodies are indistinguishable, simply refused to do anything about it, although it was quite obvious to me from the examination that I could see, forget what anybody else could see, of the conduct of the directors of direct share deal. It was quite obviously a fraud that was going to happen. And to this day, I still do not know what possessed the FCA. Certainly, I got hold of the Complaints Commissioner, I think it's Anthony Holland, and I said, this is quite outrageous. And he said, first, you have no right of action against the FSA, and secondly, I do see why you're so angry about it. So it's rather odd that we live with what I think of as a contracting party for proper behaviour, but you can't sue them if they get it wrong. If you use a doctor and he cuts your right arm off and he should have cut your left arm off, well, then the fact is you have a right of action. But the FCA, or FSA, simply doesn't have any such constraints at all. And I sometimes wonder whether it's possible for anybody to be properly constrained. I rather think it isn't. These are rules and regulations, and I shall come on to these in a moment, since they're a hobby horse of mine. I'm slightly reminded at this election time of the old lady who was asked which way she was going to vote, and she said, I don't vote, it only encourages them. but you know, we do vote and we get what we vote for, and so in a sense I have no right of complaint. Even so, I still think I do. So yeah, I know that will strike you as rather inconsistent, but that's how I see it at this point anyway. As most people here today will have noticed, HSBC are seriously thinking in terms of decamping from London. I don't blame them, really, for they have had all sorts of levies imposed upon them, even though they never had any assistance from HM government when the troubles, caused, I may add, by HM government, broke out in 2008. There is a point when the cost of regulation simply becomes utterly disproportionate. Forget the effect on human morale, but the cost of it is just astonishing in relation to how little is actually achieved. And so until society decides to kick these fools aside, and that's what they are, and that's what they deserve, I'm afraid we've got a bit of a problem on. Anyway, that is why I decided to kick off today's comments with a review of where we've got to this last year in the matter of regulation, for which we, as investors, collectively pay. The budget for the Financial Conduct Authority is of the order of £450 million a year. We pay for it. it's simple. The FCA thinks it would like to have some money and goes around all the regulated investment businesses of Britain and says, you pay this, you pay that, and so on. And then they get the money in. And in effect, there's no right of appeal because should you care to object, the next thing you will have is a series of auditors imposed by the FCA coming in to stick their nose into your business. So it's really like a medieval baron just taking the money because he feels like it. I'm amazed that people don't really get very angry about this and do something about it, but you see the problem that there is no means of bringing these ghastly people under control, at least not in my opinion. Of course, some people say, well, I don't pay anything to the FCA, which you do, and if you doubt it, you ask the financial services investment businesses that you encounter whether they pay. They will say yes, and furthermore, they will point out that they deduct it from your money. You can see it's going on all the while. So I'm afraid it really does involve all citizens just to say, well, where is the money going? To what purpose is it being spent? And I hope that people will do more of that, because it's the only way of controlling these people. At least it is to my way of thinking. You can forget writing to MPs or writing to the House of Commons Treasury Committee. They have so many complaints on their desk at the moment that they've given up. Believe you me, I've even had a letter from Andrew Tyre. He said, I don't know where to begin. We just got too much. So there it is. I'm afraid it just means hammering away until things come to order. But I thought that I'd illustrate my general point of I think it's Lord Acton's statement that power corrupts and absolute power corrupts absolutely, by reciting what went on about a year ago and what happened subsequently in relation to a decision taken by the Treasury and the subsequent events that occurred. I think everyone accepts that a government has the right to decide. It's one of its people may say that governments shouldn't do this or they shouldn't do that, but they certainly have the right to decide. And George Osborne decided that it should be easier for citizens to be able to access their pension pots. And I don't need to recite here the reasons why he thought that or the political pressures he came under to come to that view. Just looking round the room, I think there's quite a few other old age pensioners besides myself, and I think they know jolly well what they think about what happens to their pension pot at the hands of the financial services industry. And I think, understandably, people are extremely angered by that. Anyway, Osborne decided to make it much easier for people to access their money, which I don't see is a particularly bad thing. I think it's a particularly good thing. People should be able to decide what they do with their money. And they decided, the Treasury, to handle the publicity for this change by giving it to the Financial Conduct Authority. I mean, really, the idea is to have price-sensitive announcements to go through a regulated channel. This, if one thinks about it, is an insane proposition, because if the Prime Minister were to appear on the door of number 10 and say, we are now at war with Russia, I would say that's pretty price sensitive. But as to whether it should go through the Financial Conduct Authority and the Regulatory News Service, I very much doubt. But anyway, the Financial Conduct Authority decided that the best way to approach this dissemination of information would be to give the story to a journalist on the Daily Telegraph, a chap called Dan Hyde, I've never met him, who had specialised in reviewing the present absurd arrangements, since, understandably, many pensioners who were aware of the unsatisfactory state of affairs read the Daily Telegraph and would be interested in updating their understanding through that medium, whereas they would not typically turn to an announcement from the Financial Conduct Authority over the regulatory news service. Well, that seems to me a perfectly sensible approach to matters. So the Daily Telegraph, thus informed, elected to publish this story at 10:27, you'll see the significance of this in a moment, at 10:27 p.m. on its online edition. As a result, the market was appraised of a downgrade in the expectation of profit for life assurers, which might prove fairly dramatic. I mentioned 10:27 p.m. because that's more than an hour and a half. It's an hour and a half after the Wall Street market in ADRs closed. I only mention it because it's possible to deal with ADRs in America and so on. I don't think, but it was never suggested that anybody did. Anyway, the story went out at 10:27, and it gave plenty of time for people to consider what was really proposed, or what the Daily Telegraph claimed was proposed by HM government. Anyway, accordingly, the market opened the following day. The life assurers declined by roughly 10%, which is a fair slicing. And needless to add, those connected with the promotion of the share prices of life assurers decided to give the Financial Conduct Authority an ear-bashing as to how this disgraceful thing could come about, etc., etc. And in any event, they said the story was in material detail, incorrect. As a result, the Financial Conduct Authority was thrown into turmoil for about 6 hours until the full and correct statement intended by the Treasury was issued. This came out on the official Regulatory News Service website. I do not know why the Treasury decided to issue this information by this means. As I said before, I mean, governments decide and they can do it any way they like. But since the matter had been handled by the Financial Conduct Authority, that authority was supposedly obliged to issue the change as a regulatory news service item rather than briefing the press. I have no idea. They could issue it any way they like, I would have thought. And again, I must stress that there has never been any evidence put forward to the effect that somebody in the Telegraph or somebody connected with the journalist in question short-sold life insurers in advance of the publication of the story. So there's no hint of crime there at all. However, as a result of all this excitement, the managing director of the Financial Conduct Authority, Mr. Martin Wheatley, presumably aided and abetted by his chairman, Mr. Griffith Jones, who'd been senior partner of KPMG and also, I think, chairman of HBOS, decided that the only way to clear the Financial Conduct Authority's position would be to request a partner of Clifford Chance, Mr. Simon Davis, as it happens, to review matters from top to bottom as to how these terrible events had occurred. Anyway, about 6 months later, which is extraordinary to me, I mean, this is the sort of work could be done in a morning, but about 6 months later, Mr. Davis's report emerged. There was nothing interesting in the report at all. And if you wish to disagree with me, I direct you to the Financial Conduct Authority's website, and you can read the report yourself. It'll be clear to you as I continue that you'd be rather irritated to learn there was nothing in the report of any interest at all. Anyway, It proved to be the basis whereby Mr. Wheatley lost his annual bonus of £100,000 for that year. I'm sure it's been picked up for subsequent years, whilst 2 members of the staff of the Financial Conduct Authority were sacked, well, had their careers in regulation terminated. Anyway, this is a detail. Much more interestingly, the cost of this inquiry came to a staggering £3.8 million. I still can't believe how you could possibly spend so much money on so little. You'd have to be half-witted to imagine spending more than £10 on it. And so it's just, this country is supposed to be short of money, and £10 are spent on this, I think, is too much. But £3.8 million, you've got to be a regulator to think that's a sensible way of spending money. £2 million of that went to Clifford Chance. You can just imagine the partner of Clifford Chance, Simon David, would have had a call from Wheatley saying, "Would you like a large cheque?" Mr. Simon Davis, thinking of his monthly partners' meetings, yum, 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 will certainly send it straight over. Cash deposit, £500,000, and we'll think of something else for next week. Anyway, that's the money that went, £2 million. I'm getting there. And another £1 million went to Kingsley Napley, whose job it was to take affidavits from the people who played, it was said, a part in this affair. I don't know why you couldn't have Clifford Chance taking evidence, but apparently it's very important to waste money. I don't know if anyone here today is from Kingsley Napley or associated with anyone who knows Kingsley Napley, but I've never myself taken the firm seriously, because Sir David Napley was a con artist of the first order. I'm going back 30, 40 years. He used to rock up in court as a solicitor, remember, not as a barrister, and he would have chaps bringing in textbooks, feet of them, to store beside him. The idea behind this was to give the impression to everybody in the court that Sir David Napley, who was a great intellectual who used to work everything out by reference to books and so on, he wasn't interested in that. His sole purpose was showmanship. Anyway, the fact is, Kingsley Napley got £1 million, and on top of that, some computer firm got money for updating the IT services, or the means whereby information is distributed within the FCA. And for this, they were paid £60,000. £60,000. And on top of that, finally, I will stop this list of calumnies. FTI Consulting got £60,000 for their work on the public relations side. This, remember, is over a matter which was only worth £10 to start with. Then the extra was made up by VAT on top, and that came to £3.8 million. I don't think it's possible to take these people remotely seriously. They're just filching money from society, and it really is time that people went round and kicked them. But as far as I can see, there's no one who's prepared to kick them, and I mean properly kick them. Anyway, the result is that that's what we got. It astonishes me, in the light of the recital here, that Mr. Wheatley is still in post. I mean, surely he should be fired. However, unbelievably, it gets worse. Late in 2014, or long after this nonsense with Clifford Chance had emerged, Mr. Steve Webb, the pensions minister, issued a further price-sensitive observation in relation to the life assurance industry. This declaration did not appear on the Regulatory News Service. Why? Not explained to anybody why. It is hard to escape the conclusion that the Treasury, the Pensions Minister, and the Financial Conduct Authority are collectively mad. If they had their own money taken away from them, they would never behave in this way. Their feckless and pointless behavior is entirely the result of foolish politicians empowering people who should never be let anywhere near a checkbook. Turning elsewhere, I'm very impressed that the authorities seem to have little or no will to do anything on time where there is prima facie evidence of criminality arising in the conduct of directors and others. Take Quindell last year, along with the conduct of their advisors. The Financial Conduct Authority, even when appraised in detail of the miscreants' behavior, simply did nothing. Well, it did do something, actually. I got a letter from the FCA which said, if you write to us, you mustn't write abusively. Yeah, well, you know, as I say, there's nothing you can do about it. If you have ceased to respect people, you just hammer them until eventually they might smell that something's not entirely right with their presentation. At least so it seems to me. Although Quindell has extraordinarily recovered its commercial prospects, this recovery was not obvious a year ago, and indeed it seemed to me and a number of others that investors were simply having their money stolen from them by the miscreants. It is incredible to me that the authorities can be so slovenly and slow in dealing with evidence made available in the public domain. I offer another example. About 6 weeks ago, I and one or two others identified what is a major stock distribution fraud going on right now at Gate Ventures. I wrote in my usual abusive manner to Mr. Wheatley to ask him to do something about it. Jim Slater told me, he said, well, you can't write that, it's very immature. The letter to Wheatley began, this matter is so simple, I write to you about this matter because it's so simple that even you can understand it. Again, he just thinks I'm being a bully. But anyway, I wrote in my usual abusive manner to Mr. Wheatley to ask him to do something about it by way of illustrating blah, blah, blah. Needless to add, he's done nothing. Or if he has done something, he hasn't done anything that is sensibly required. I hasten to add that the proper remedy is to suspend the share price until the management who control the share price are shown to be behaving properly. I may add that in the background of these frauds, or this fraud, is Sir Tony Baldry, PC. He's retiring at this election. But I find it astonishing that a person who's been so publicly recognized in this country should be associated with dodgy company after dodgy company. I dare say he's not paid a lot as an MP, but you would think that he would work out something about how to deal with matters. Anyway, he doesn't. It can be argued that the main group of people disadvantaged by the Gate fraud are suckers in China or Hong Kong. But the mere fact that Gate is quoted in London means that those who use or consider using the London market might alight upon it. That alone should surely cause the FCA to act. To behave otherwise is to degrade the London market. For what it's worth, yesterday, my friend Lucian Myers wrote a detailed letter to the London Stock Exchange demanding that Gates be suspended, amongst other requests. And we'll have to see what happens. But anyone left holding this stock in the coming days is, in my opinion, in a very high-risk investment. Incidentally, I am not impressed by those associated publicly with Gate, since they have taken a nothing to do with us approach. They know full well that Gate declines to issue fresh stock for cash at its vastly ramped-up price. The promoters know full well that any such policy would simply cause the price to crater. And of course, the proof of this is that they simply are not trying to issue fresh stock at a substantial discount to the current price to raise for cash. That, to me, is the proof that this is a fraud. It must be. For a company which is said to be about investment, it must be a fraud on that basis. Turning elsewhere, and before I affirm stock ideas, I remarked that the current climate of absurdly low interest rates being available to savers, caused by quantitative easing, has caused investors in general to give up thinking for themselves. This is extraordinarily dangerous. The fact is, throughout history, interest rate rises and or sudden breaks in confidence of holders of stock can emerge. If I had to guess where and why the market will break in the UK at least, I would hazard the guess that the great smokescreen which all the major parties have put up to mislead the electorate over Great Britain's finances might suddenly clear, and as a result, the gilts market could slump as overseas holders and others withdraw en masse. I mention this because some people here today may have noticed that the Institute for Fiscal Studies says every single party at the standing election has failed to present a review of the financial position of this country, which I find really quite extraordinary. The figures are much larger than even those officially issued. It's said to be £1.5 trillion. I think the true figure is probably closer to £3.5 trillion. No one seems to care. These are massive sums, and when it unravels, there'll be hell to pay. Anyway, when interest rates rise, which they will have to do, because I don't see how we can do anything other than resort to printing paper to inflate our way out of GB's liabilities, I expect small caps to be poleaxed. It's got to happen. And if there's the slightest doubt about a share's ability to stand the changed climate, well, that doubt will be swept away by events when it comes. Perhaps inconsistently, I still think it is sensible to buy the cheap small caps on AIM, for there are quite a few standing at a discount to net cash. These have terrific defensive qualities, since obviously the management can always deploy the cash to buy in the stock, which of course is not the case for companies that have no cash and no net asset backing. I will just casually mention one which I've mentioned before elsewhere. The Boliven is quite clearly standing at a very large discount to cash, whilst having perfectly interesting prospects elsewhere. There are quite a number of others in the market which are in the same position. I also mentioned something which I considered yesterday morning through a call with to Andrew Monk of VSA Capital, which is that I shouldn't say this because Madagascar Oil, the company in question, is clearly short of cash, It's a development situation in Madagascar, which is not everybody's idea of heaven, investment-wise. I mean, it may have jolly good beaches or whatever, but it certainly it must be questioned from an investment point of view. The story of Madagascar oil is potentially astonishing. Everyone here will have noticed how David Lenigas, in a brilliant piece of Legerdemain, appeared to promote UK oil and gas 2 or 3 weeks ago. And it's a pity, really, that he isn't in charge of the share price of Madagascar oil. But the fact is, Madagascar oil, which is capitalized at only £25 million, or thereabouts, might have 10 billion barrels of oil, which many people say is very fanciful. But as I say, it might be there. And it's heavy oil, which is not ideal. But it's available. In fact, it's so available, it's even seeping up through the ground. Now, all con artists use things like seeping up through the ground, but I don't think Andrew is proposing to con anybody. It's just a fact. And this enormous oil field, and it is there, it's not a speculation as to whether it's there, will surely attract long-term investors' eyes. I understand that Exxon and Mobil are out there, to name but two, and there are plenty of others apparently having a look around it. And of course the oil price climate is not particularly favourable at the moment, although that can change very rapidly, as I need hardly point out. And the fact is that I think as a speculation, Madagascar oil at 6 or 7p, whatever they are, is a terrific bet. I mean, I must stress that it's a bet. It can't be described as a sure thing. But it could easily go up many, many times from here. And I dare say it can fade away to nothing as well. But the days when these junior exploration stocks just constantly go down, I suspect are coming to an end. It's been going on now for 3 or 4 years with occasional blips arising at certain stocks, but in the main it's been down, and I think that has probably come to an end. I can't be certain about that, but when you think about it, people have sold out. I mean, there's only so much selling to be done. Over on the shorts, I thought I would mention the technical ones, but there's no point because I don't understand them. For instance, I'm told that tungsten is terribly overvalued, but since I don't understand, I've tried. Since I don't understand the business, I just can't develop the required revulsion to short it, if I can put it to you that way. However, it's quite interesting how investors are looking at matters at the moment. There's a company quoted, it's an investment company, quoted called Allied Mines, ALM, and that at £7 roughly is valued at around £1.5 billion. Well, the fact is it is an investment company, and net asset value is less than £500 million. Well, just what accounts for that £1 billion gap? And I call that hoping. It's really not based on what is realistic. And when you think there are plenty of other investment companies which are trading at a massive discount to reasonably assume net asset value, you have to wonder whether people are insane. Actually, I got a call from the supporters camp for Allied Mines, beg pardon, yesterday afternoon, and he said I should mind my eye because the buying pressure is going to come on. Well, bring it on, say I, and keep selling them because it'll end in tears as share prices go. and that is the result we're in. In my home area, changing subject away from science, which I really has passed me by, in my home area, Kensington, the 12% stamp duty imposed a few weeks ago has brought property sales of the millions of pounds properties to a grinding halt. This is not entirely surprising. After all, if you buy a property for £5 million and then, as an afterthought, pay £600,000 to George Osborne, which you never get back, the thrill goes out of the transaction, rather. And then, of course, the sellers who think they're entitled to £5 million refuse to sell, and there the market sits. Nothing happens. I only mention it because Foxtons, whose Mini Coopers, I think it is, buzz around the area. Apparently they're very effective agents, at least I'm told they are. If you want to shift a lot of stock in the property world, you get in Foxtons. But anyway, nothing to do with me. Foxtons is now at around 200p, is trading at comfortably over 4 times net asset value. And I think it's quite capable of going into loss-making mode. I don't know when it is. Foxtons would reply that their management side, i.e. the collection of rents on behalf of various investment property owners, is their backstop. But as anyone who knows management accounting for property, and I do, actually, it happens, it's work that has to be done conscientiously and carefully, year in, year out. It's certainly not a spivvish operation of the sort that Foxtons would offer to a wider world. I hope nobody from Foxtons lawyers are here. Yes. My life is full of writs. I don't want yet another one. Anyway, Foxton strikes me as an absolutely clear short, and I'm surprised that it is where it is in the light of the climate. It's certainly a very good example of a company that benefits by the lunacy that is quantitative easing in practice, which is worth thinking about. Changing industry, I would mention that I made a huge amount of money on Trinity Mirror because I always took the view that this thing would not go bust. And as a result, I was well pleased. However, I've stayed abreast with the thing through the phone hacking trials, and Trinity Mirror apparently faces damages for each claimant, not of £80,000, as it was originally advised, but a thick 6-figure sum per claimant. And the legal fees on top come to another thick 6-figure sum, such that there might be claims running not to say 20 or 30 million pounds, but it could actually, theoretically, be as much as 400 million pounds. Well, if that's the case, Trinity Mirror is bust, or virtually bust, and how they buy Express newspapers, which is what Richard Desmond has proposed, is really beyond my understanding. So I think Trinity Mirror is a terrific short. You can borrow stock. The margin rates vary, sometimes as much as 25%, but others do 10%. And it's a cracking short. Anyway, I, of course, make the general observation that it is very hard to short successfully in this market. But one has to stay there for when the big break comes, as it most assuredly will. And on that note, I see I've left myself 2 minutes to answer questions of which I'm sure there are none.